Good afternoon. Good afternoon. Welcome to another edition of Monday Market Picks. It's Monday, the 30th of March. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. Now, oil is climbing higher and stagflation concerns are increasing. The US is moving ground troops towards Iran, making this whole assumption of a short war harder and harder to defend. So how should ASEAN be positioned into this? We speak with Maybank Investment Banking Group's Regional Head of Research, Anand Padmakanthan, on his views as well as his stock picks. Now, apart from that, one key beneficiary obviously is oil prices, and with that, the oil and gas sector as well as the shipping sector. Husseini Saifi joins us to talk to us about a very timely initiation report on this sector, along with initiations on Seatrium and Yangzijiang, as well as our views on Marco Polo Marine. And there's also this question on SATs. Is this whole crisis good or bad for SATs? There's a lot of different opinions out there. So we have a fresh piece from Miao Liu who talks about this and why she's retaining her buy call. Plus, we've got some fresh charts from our chart guy as well. So lots to go through. So do stay with us. Let's start with our regional head of research, Anand. Anand, welcome to the show. Now, when you look back at the start of this year and when you were speaking to clients versus now, what has been some of the biggest shifts in the investment themes that you've seen?
Yeah, thanks, Dylan, for having me on. I think it's pretty straightforward that a lot of the positive underpinnings we started the year with have basically been pushed to the side, and there's a lot more focus on the negatives. I mean, just to give you some context, when we kicked off the year in January, when we wrote our ASEAN strategy report, our headline was sanguine. Things looked pretty calm. There were a lot of drivers to look forward to for ASEAN, the AI boom, exports. We were talking about oil at $65 per barrel. That was our assumption for the full year. Interest rates coming off still for many parts of ASEAN, like Indonesia, Thailand, the Philippines. So that's going to stimulative for consumption. And also a focus on policy reform because governments had the bandwidth, not having to deal with a crisis. They could focus on policy reforms in countries like Malaysia, Thailand, Indonesia. So there's a lot to look forward to in January. And of course, you had the expectation of a continuously weakening US dollar as an additional tailwind for emerging markets like ASEAN. So now, Dylan, you're absolutely right. Things have changed a lot. A lot of the things I just mentioned no longer hold water. Oil is above $100, as you just said, and we're facing a prospect of a longer war. It's going to stay up there for a while. And that's just one giant tax on global growth. Yeah, higher energy prices. Interest rates are not going to go down anymore because there's a huge inflation risk now for all the economies in ASEAN. So you don't get that stimulus anymore. And obviously, governments have no time to focus on, deeper policy reforms. They're too busy firefighting this energy crisis and this stagflationary risk.
Got it. So yeah, so a lot has changed in just a few months. So when so the question I have is, are investors really getting it? Are the markets really underpricing the geopolitical risks of this Middle East conflict, or do you think it's getting priced relatively accurately?
Yeah, that's a great question. It's a question being asked by many people. If you read The Economist, there's a lot of question marks whether, markets are, just not getting it. Yeah, basically, because, a lot of markets have held up better than expected, despite this deluge of negativity and the longer term repercussions of what's happening in the Middle East. I can only speak for ASEAN, and I can say in terms of the price action we are seeing in ASEAN markets, I think investors in this part of the world kind of get it, kind of can differentiate the sort of the more resilient countries and markets from the less resilient ones. I mean, when you look at our positioning, which we sort of articulated, refreshed last week, we were saying Malaysia and Singapore stand out as being more resilient for a variety of reasons, fiscal strength, Malaysia's a net energy exporter, while the other four countries are perhaps more vulnerable. And when you look at the price action over the last 2 to 3 weeks since the Iran war conflict started, that's basically being borne out. Singapore and Malaysia, yes, have corrected slightly, but they're holding up quite well. And the other four ASEAN countries are continuing to see pressure on their benchmarks and they're drifting lower. And I think our macro view also echoes this kind of positioning for ASEAN and vulnerability here.
Got it. And so, where do you see the biggest impacts across the ASEAN six, and which sectors do you think will benefit from this situation?
Yeah, so the bad news first. I think we are feeling less comfortable with the positioning of some countries from a top-down perspective. We have reduced Vietnam from an overweight to a neutral positioning. This is really the issue with their oil and gas reserves. They're quite low, among all the ASEAN countries. Theirs are less than 45 days. So the pass-through in terms of inflation shock and potential repercussions for the currency and consumption could be quite negative much sooner than for many other countries facing the same shocks. So we've reduced our weightings there to neutral. Philippines, dependency on imported oil is almost 100%. Yeah, so pretty straightforward transmission into the economy is quite negative. The other big negative for the Philippines, maybe not so obvious on the surface, is the fact that half of their overseas Filipino workers are situated in the Middle East. So if there's disruptions and dislocations in the Middle East, that could interrupt the flow of remittances back to the Philippines, and that would have a negative impact on consumption. So those are the two countries where we are, quite a bit more cautious on. We're quite neutral on Indonesia and Thailand, and as I mentioned before, we're still pretty comfortable with Singapore, Malaysia. Sectors we like, you already mentioned one, oil and gas services. I think the more obvious winners would be the upstream guys. That's direct, right? Oil prices higher. The stuff you're pumping out of the ground is worth a heck of a lot more. So people like PBS in Vietnam, Medco in Indonesia, Dialog in Malaysia would be the sort of names you'd be looking at. I think in Malaysia and Singapore, the oil and gas services companies, which you cover a lot of in Singapore, we cover a lot of in Malaysia, would also be second-order beneficiaries. Some other sectors I'll just quickly flag that we think will get more positive headlines going forward. One is renewable energy. Yeah, I think the shock has really made everyone realize we need more energy security. Yeah, we can't be dependent on Middle East oil and gas long term. So I think there'll be a renewed push by many countries to accelerate their renewable energy ambitions. And that would be good for state utilities who take care of the grid, like Tenaga, where you have to invest a lot more in grid upgrades, and that's going to return a lot more on your capital. Also, solar actual players who do renewable energy, like say SolarVest in Malaysia. Just one or two more, which are perhaps a bit more on the periphery, not so many names in ASEAN, but worth talking about. One is defense. Everyone's going to be spending a lot more on defense now, even more so than last year when we got the initial taste of Trump, so to speak. So stocks like ST Engineering in Singapore add value. I think Singapore does have a bit of a monopoly on those kind of specialist firms catering to the defense industry. And finally, food security. This is something that we're not really talking about right now in a big way because it's a bit of a second-order effect. But history has shown that higher oil prices invariably lead to higher food prices because fertilizer costs more, transport costs more. So all those things will feed into food prices. And the inflation shock there, maybe you want to look at some fertilizer plays in producers in ASEAN. There are a couple in Vietnam like DCM, DPM that we cover that would be interesting.
Yeah, I think the food security angle is still really not spoken about much, and especially 2026 is supposed to be El Nino year as well. So, you're going to have a lot of stress in terms of agriculture, even without this whole oil shock. So, something to watch out for. Now, Anand, when you look across the region, what are your top 5 conviction picks?
Okay, I mean, to be honest, in a time like this when there's so much uncertainty, and all indications are that the war may extend longer than we expect, I kind of like the safe haven play that is Singapore. Yeah, I like its fiscal reserves, which give it a lot of firepower to combat the second order effects on consumption, etc. And of course, it will remain a safe haven appeal or play for the region. So I think something like SGX is very interesting to me because one of the side effects of this huge amount of uncertainty is a lot more activity in capital markets, a lot more trading. There's a lot more hedging of risks as well, which Singapore is a hub for that. So I think SGX I like a lot. I also like ST Engineering for that defense angle. I think if you look broader region, something like Tenaga in Malaysia, nice low beta play. I think there's a big chance that they could accelerate their contingent capex to upgrade the grid, because as I said, we would expect renewable energy plans to be accelerated across the region, and one of the beneficiaries would be grid operators who would need to invest and of course earn a return on that investment. Elsewhere, I'd be a little more selective. I wouldn't be very much into consumer discretionary or banks, given the risk to consumption demand, the risk to credit quality. So I would look at things like telcos, something like Singtel or True in Thailand. These are nice, safe, solid plays, good yields, good place to ride out the uncertainty in the broader economy. And finally, fifth one, healthcare. Yeah, we had a big listing in Malaysia 2 weeks ago. Sunway Healthcare did amazingly well, up 30% from the IPO price. I think healthcare plays across the region will get renewed interest in the current environment.
Got it. Anand, thanks for joining the show.
Most welcome.
Now let's move on to another sector that Anand spoke about, one of the key beneficiaries, which is the oil and gas, as well as the shipping sector. And we've got a very timely initiation from Hussaini, who's initiated on the offshore and marine sector. In Hussain, in that you claim that offshore oil and gas is on an upcycle, while shipping has peaked. Can you break this down for us and highlight what are some of the key themes that are playing out in each segment?
Yeah, sure. Thanks, Thilan, for having me. So, our core view is very simple, that both offshore marine, which is oil and gas, as well as offshore wind, as well as shipbuilding are cyclical in nature, but they are at different points in the cycle. So, offshore oil and gas is improving because offshore remains the low-cost source of new supply at about around 37 to 43 USD per barrel. And the link is that the FPSO demand is still high at around 40 to 50 units over the next 5 years. So for context, FPSO are those large platforms used to extract oil from the offshore sites, and each of them cost around 3 to 4 billion USD or more than that. And globally, right now, around 160 FPSOs are operational. So 40 to 50 on top of that signifies a significant demand coming from that segment. So that underscores a strong demand pipeline for the offshore oil and gas. Similarly, for offshore wind, as per various industry estimates, the expected demand is going to be around 14 to 16% CAGR over the next 10 years. So clearly, those two segments, offshore wind as well as offshore oil and gas, is in the upcycle. On the other hand, shipbuilding, especially container ships, looks closer to peak, with order book already at around 32% of the fleet size. So because of the last 10 years, the order book had significantly ramped up, and now it is at 32%. And at the same time, the new orders we are seeing is because of the already high order book, the new fleet size or the new order book or the new orders are coming down. So it declined around 27% last year and around 12%, expected to decline around 12% this year. This is on the volume side. We are also seeing pricing pressure. So the prices of new ship orders declined around 5 to 10% last year, and a similar quantum is expected this year as well. So clearly, both are in different cycles. One is going up, offshore wind as well as offshore oil and gas, whereas the shipbuilding is going down in our view.
Understand. Now, with this, you initiated on Yangzijiang with a hold. Now, this is an unconsensus view, especially the stock is up about 59% in the last 12 months. What do you see differently from the street?
So it's a non-consensus hold. So maybe, yes, you're right that it has done tremendously well last year. And honestly, last year, Yangzijiang surprised on multiple fronts, including a sharp margins lift. I think their margins went up to 34%, which is almost, highest globally for the shipbuilders. And they also increased their dividend payout. So this helped in share price outperformance. Also, next 2 years, 2 years look quite secure, helped by execution of its order book of around 22 billion USD. Now, what we see differently is not the near-term backlog, but the incremental upside from here. So, order intake. So we are really concerned about the order intake. So last 4 years, from 2021 to 2024, order intake was around 8 billion or 7 to 8 billion USD per year. But last year it fell down to just 2.5 billion. And so order intake came down. And because of competition as well as the domestic within the Chinese domestic market, the pricing are also coming down. So last year it fell down by 5 to 10% and is expected to decline again by 5 to 10% as per management. And management is also highlighting, Yangzijiang management is also highlighting that the 34% margins are unsustainable and they expect it to normalize. So net, we do see quite a bit of headwinds. Also to note is that this is highly cyclical and to an extent dependent on global GDP growth and things like that. So those are the factors which in our view are likely to weigh, and that's why we initiated a non-consensus hold on the name. Maybe one final point to also note on Yangzijiang is that almost 100% of its revenues are in USD, but only 20 to 30% of the costs are in USD. The rest are in Chinese yuan. So as the USD depreciates, that also impacts the company negatively.
Understand. Now, Seatrium, though, you initiate that with a buy nearly 40% upside. Despite higher oil prices, the stocks really had a lackluster performance. So what's going to drive this divergence?
Yeah, so last year it was a bit of a soft year for Seatrium. And I mean, I believe Anand did highlight it quite a lot that at the start of the year, expectations for the oil was low. And last year as well, it was the case. So that kind of weighed on Seatrium to an extent. And honestly, last year, the order intake for Seatrium was on the lower side. They just got an order of around 4 billion USD, more than 4 billion USD, whereas their revenue run rate are around 10 to 11 billion. So that weighed on the stock last year. Now, where we see the difference coming is the next phase, which we see looks much better. So not that, as Anand highlighted, that energy security and energy diversification are the key themes, which is gaining momentum by the day. Now, oil price correlation for Seatrium is very high. So their new order to oil price correlation is almost 70%. In terms of order pipeline, Seatrium is now targeting more than $32 billion Sing dollars in order pipeline. And we model that the going forward order wins will be in the range of 10 to billion US Sing dollars over the next 2-3 years. And last year for the context was just more than 4 billion. So we expect a significant acceleration in order intake, and given what is happening in Iran or in the Middle East, so there will be a need for energy diversification. Seatrium mainly focuses into Americas region, which is Latin America and Gulf of Mexico, as well as there is a need for energy diversification more towards renewable. So Seatrium is focused more into European offshore wind projects. So in our view, net means the order intake should accelerate it from this level. Also, final point is on the margins lift as well. So in 2024, Seatrium margins was 3%. It increased to 7% last year, but still, it remains significantly below compared to the global markets. And management is expecting it to hit the project margins to hit around mid-teens. So we are expecting by 2028, the margins should improve from 7% last year to almost 11% by 2028. So there are multiple upside for Seatrium in our view.
Okay. And then, just in the interest of time, we also highlight Marco Polo Marine, where we have a conviction buy on that stock as well, largely driven by the order book growing quite aggressively. We got one of the key veterans in the industry continuing to raise his stake in the company, and it is geared towards both oil and gas as well as sustainable energy with wind farms in Taiwan. So do have a look at that in our report as well. Thanks, Hosseini. Now let's turn to SATS. Niamia Liu keeps a buy rating on that stock, and here's why. We see limited direct Middle East exposure, only about 3% of revenue, with operations concentrated in Saudi Arabia and Oman, thereby containing immediate geopolitical risks. Risk is viewed as largely second order in nature, arising from potential airline capacity reductions, flight rerouting, and fuel uncertainty, rather than direct operational disruption. Now, there's no direct fuel cost exposure, positioning the business defensively in a high oil price environment, where oil acts more as a demand headwind than a cost driver. Downside is manageable under stress scenarios, with a prolonged conflict implying only about 5 to 8% impact to earnings. They've got a diversified global network. Cargo rerouting and supply chain adjustments could actually support market share gains over time. So we keep our buy call on this stock, and we think it'll actually be a key beneficiary from a longer war. So do have a look at that stock as well. Now, finally, on the chart, from our chart guy, we got a couple of new trading ideas. China Aviation Oil. I think we got a question as well. We got a accumulate or a trading buy on that. Even though they've gone through a sharp correction, decline has mostly found support on the 21-day EMA. So we think there'll be more momentum on the upside for this stock going forward. We also like TIANJIN Pharmaceutical. It's been trading more or less sideways, but we think that that correction phase is ending, and it should actually support another leg higher. Also, don't forget, on the 7th of April, we've got Dan Ives along with Seth Basham and myself talking about the US geopolitics as well as Singapore markets. It's a live event at our North Canal event hall, so do join us live, or you can also join us online as well. So don't forget that, and do sign up. With that, unfortunately, we're out of time today. Thank you so much for joining us. We wish you a profitable trading week, and we'll see you next week.